This is the FM Gold channel of All India Radio. In the program Money Talk, now we bring you a dialogue on reduction in trade deficit. The participants are Ajay Sahai, DG and CEO, Federation of Indian Export Organizations, and Paranjay Guha-Thakurta, economic journalist.
The trade data released by the government on Monday indicates that exports have grown by 13.5%, and this is the fourth consecutive month that exports have grown, even as imports, or the rate of growth of imports, has dropped somewhat, keeping the trade deficit significantly below the level that was prevailing in the previous financial year. Till the end of October, the trade deficit is expected to be around $22 billion, which is below the last year's level of $112 billion, which indicates that the current account deficit, which has been a problem for the government, would ease. In October, exports rose 13.5% and imports fell by 14.5%, leaving the trade deficit at 10.5 or 10.6 billion, which is almost half of the year-ago figure of about 20.2 billion. This is the data that has come out from the Ministry of Commerce and Industry on Monday. Mr. Ajay Sahai, how do you see the trade data?
Look at the situation in 2013 is far better than what we witnessed in 2012. And of course, Europe is a cause of concern, but the reports which are coming from Europe, they are pointing to moving most of the countries to a positive territory. US data has been quite impressive. Even the employment data which has just been flashed shows to a very healthy recovery in the US. Emerging economies are doing well. So overall, it's a very good scenario for the exports which is emerging. In last 3 months, we have seen the double-digit growth in exports. And we feel that from November onwards, we may see close to 15 to 20% growth in export. What we personally feel that we will not only be crossing the export target of $325 billion, we may finally land up with an export of close to $340 billion. The good news is that even oil imports is not growing in value terms. There has been around 3% growth in oil.
In the sense that there was an expectation, if I can briefly interrupt you, of possibly a military intervention in Syria, which was, there was a fear or an apprehension that oil prices could go zooming, but the situation has thereafter calmed down. And oil prices have been relatively stable, and that's a major factor because, as you're aware, India is importing 80% of our total requirements of crude oil, and oil accounts for about a third of our total imports. Yes. Please carry on.
I will not find just flashing the October figure. Let me look at a broader picture of April to October. Oil imports have grown up by around 3%, whereas the non-oil imports have gone up down by around 7%.
So oil imports 3%, non-oil imports come down by 7%.
7%. If you look at the non-oil imports also, I think it's a good sign that edible oil import has come down, farm fertilizer imports have come down, coal import has come down. But
and what I think is even more significant is that imports of bullion, gold in particular, seems to have fallen considerably because the government has taken a number of measures, including an increase in the customs duty and various other restrictions to curtail imports of the yellow metal.
If you look at the gold import, I think if you are comparing April-October period only, it has come down from 28 billion to 24.5 billion. But I think finally, instead of having an import of 44 billion, which was recorded last year, this year may touch around $35 billion on gold and silver. So what we personally feel that at the end of the year, our trade deficit, which was around 190 billion last fiscal, may come down to around $140 billion this year.
In terms of percentage of GDP, there is an expectation that whereas at the end of the year that ended on the 31st of March 2013, the current account deficit as a proportion of our gross domestic product was about 4.8%. This might come down in the region of 3.2 to 3.5% of GDP. Is that a reasonable expectation?
I will give a little different mathematical calculation. Last year our trade deficit was $192 billion. Finally we have a current account deficit of $88 billion. This time around 50 billion saving will be on imports in merchandise sector. So if the inflows continues in the same fashion as they happened last year, our current account deficit should come down to around $40 billion. But since there will be little political uncertainty because of the general elections, there may be some little inflow which may be impacted, and therefore I personally feel that we may end up the year with a current account deficit of close to $50 billion.
Which would be, in your opinion, somewhere in the region of 3.2?
It will less than 3% of the GDP.
You think less than 3 or a little more than 3%?
No, it's less
3.2 3 points.
No, because this year we expected the GDP to be to around $1,800 billion. So if finally it will end before $54 billion.
What we found is that the rupee sharply depreciated. It was very unexpected that it all happened, and the bulk of that depreciation, if I will recall correctly, happened in the months of July and August. Thereafter the rupee strengthened, but again the rupee shows signs of depreciating vis-a-vis the American dollar, and especially when, as both the finance minister and the governor of the Reserve Bank of India, Dr. Raghuram Rajan, had said that, this whole tapering of the US Federal Reserve's decision to purchase bonds will happen sooner rather than later. So we should be mentally prepared for a situation where the rupee could depreciate. How do you read the situation?
No, if you look at the rupee, how it's moved today, it has already crossed 64 to $1. And the trend is pointing that it may again be depreciating further. For an exporter, I think we are not very much concerned with how the rupee behaves. For me, it is more important if rupee behaves in a little concerted manner over a short time.
What do you mean to say you avoid the volatility part?
I avoid the sharp volatility because in any international transaction there has to be volatility, so we have to live with little volatility. But what I'm saying that instead of having a 5% depreciation over a week's time, if that happens over 6 months' time, industry would be comfortable. Okay. Otherwise, we will not be encashing of that even on export.
Okay. There was one expectation that the government said that because of expectations that the rupee would depreciate against the dollar, exporters were not repatriating their earnings. And for that, as you know, the Reserve Bank of India issued a number of directives, a number of measures. To what extent have these been successful?
If you analyze that, most of the exporters are taking a pre-shipment and post-shipment credit, and that too in the foreign currency, so they are not getting advantage of rupee depreciation because in any case they are surrendering equivalent amount of dollar to the bank. Secondly, I don't feel that any genuine exporter will delay the repatriation of his export proceeds. Of course, RBI has that view in mind and they have curtailed the period of repatriation from 360 days to 70 days. But if the global situation has not improved in terms of liquidity, in fact, a lot of exporters are facing the problem. Let us also not forget the fact that the period of repatriation was being used as a marketing tool to get more orders. There are countries like China, there are other countries also who are extending a 15 months period to the buyer. So if they are giving you 15 months period and if you are curtailing that to 6 months or 9 months time, you are basically not using that as a marketing tool for further exports.
There has been a view that, many of the items that are exported from India, notably garments, textiles, handicrafts, sports goods, processed foods, leather items. Of course, there are other handicrafts. We could also include some of the gems and jewelry and things like that. These items, they are facing markets. I mean, they've been going through a situation over the last few years where their traditional markets have either shrunk or disappeared altogether due to the Great Recession in the West, in the United States, in Europe. Now, this has had a negative impact on the Indian economy because these are all labor-intensive sectors and employs large numbers of people. To what extent has this situation continuing that the items which India exports, the markets for them have not grown or shrunk or disappeared altogether? Because it's all very fine to say the government has a look-east policy and should have a look-east policy, but the Western markets and the shrinking of the Western markets due to the Great Recession, what's been the impact?
No, in fact, the industry has recognized this fact long ago, and they also know that there is no point in keeping all eggs into one basket, and that's why they have pursued the philosophy of diversification of their export base. And many of the exporters who were hitherto concentrating in Europe or North America, they have moved to Asia and Latin American countries. If you look at the diversification of India, 10 years back, Europe and North America were contributing to 50% of India's exports. And if you are talking about the traditional sector, they were accounting for roughly 3/4 of India's exports. Today, their share has come down to less than 33%.
What are these items that would account for roughly 33% of India's export?
I will include handicraft, I will include garments, I will include leather in that. For carpets also, we are seeing that many of the Asian countries and ASEAN countries are emerging as a market.
Would you also include gems and jewelry, which are also import-intensive?
Gem and jewelry, Middle East has emerged as a hub. We are moving away from Antwerp, and most of the exports which was going to Antwerp was accounted under the EU. Now it is being sent to most of the GCC's country, and that's why we are saying that gems and jewelry diversification has happened not only to Asia, even to Latin America. Many of the Latin American countries has now emerged as a major buyers for these products.
Mr. Sahai, the other question that one of our major items of export have been apparels and garments and textiles also. And we are seeing again a growth taking place. It had been argued that in the recent past that basically what India was exporting, these traditional items, is facing intense competition. Not just from China, but from Bangladesh, from Vietnam, from other countries of Southeast Asia. And then it was said that, look, this was not the way forward. We saw what happened in Dhaka, the big tragedy that happened. And as you know, Bangladesh is a major exporter of apparel and garments, but we also saw the pathetic conditions under which women in particular are employed. So how do you see the Indian apparel exporting industry vis-a-vis the competition and in this bigger global context?
No, if you look at manufacturing and if you look at assembly line segments, in assembly line segments, some of the Southeast Asian countries are more competitive than India. But if you look at the emerging market of Europe, which is very fashion conscious, I think India is ideally suited to supply to European countries because they are not looking...
Despite the recession in Europe, you're saying?
No, definitely, because I'm talking about a value-added segment of garment. I'm not talking about the mid segment. I'm not talking about the lower segment. I'm talking about the top end segment. In top end segment, the volumes are not much and they are a fashion conscious state. So most of their garment exporter, therefore, they are very eagerly looking towards Indo-EA FTA. Why we are losing out to some of the Southeast Asian countries, particularly in Bangladesh, because they enjoy that duty concession in Europe, which is not available to us, and that's why this is happening. But I think major opportunity for India is coming because China is slowly moving out of even textile sectors. We are seeing orders for cotton yarn flowing to India. We are seeing that orders for kids garment coming to India. And when you are talking about the Vietnam competition emerging from Vietnam, it is not the Vietnam. It is the Chinese investment which is flowing into Vietnam and taking advantage of cheap labor in Vietnam, which is definitely reflecting the competition.
And also Bangladesh.
Bangladesh is always there. But I think the recent incidents in Bangladesh has in fact forced many of the large departmental stores also to look for alternative source of supply.
Okay.
And India is emerging as one of the important source of supply.
Okay. One other question. How important are protectionist tendencies? The attempt to enforce, not just labor standards, but environmental standards on Indian export items.
What we feel that if with any of the country, if you have a sizable trade deficit, the other countries try to push a kind of non-tariff barrier or technical barriers to trade. That's why we always believe there has to be very healthy trade. You cannot have an even out trade scenario. But it is very important that not only we pursue these kinds of philosophy, but we have to maintain these kinds of philosophy when we deal with our South Asian neighbors also, because there is a general feeling in those that India already has huge trade surplus with them, and that's why they say that when you are talking about Pakistan competitors, they say a lot of non-tariff barriers which India impose. So these are the natural tendencies. If you cannot restrict the import through tariff, you will have to employ non-tariff barriers.
The onion price is suddenly going up. And people were saying, look, we should not have been exporting onions earlier. And then the onion exporters say, no, these are long-term commitments. What are your views on how better that we can calibrate the way in which exports of agricultural commodities take place in a manner that it does not have an impact on domestic prices?
I think one good thing is that government has already decided they will not be regulating value-added agriculture products. So you have little stability. Look at from the perspective of the exporter. He has developed a market. He has committed to supply to a particular country, and all of a sudden if you put a ban, it puts the exporter in a very precarious situation. Even for onion, government has revised the minimum export price, and if people can export over the export price, I think there is no harm in that. If you are a part of the global production, you have to look at alternative mechanism. At times you have to export and you can import also.
In other words, it's not going to be an easy task to balance the competing interests of the exporters of agricultural products and the interests of domestic consumers who want lower prices.
The point is that if every country feels in that way, you cannot trade. Let us be allowing free exports, and if required, we can allow duty-free imports as well.
Thank you so much, Mr. Ajay Sahai, for giving us your views on a very wide range of subjects pertaining to India's foreign trade.
Thank you.
You were listening to a dialogue on reduction in trade deficit. The participants were Ajay Sahai, DG and CEO, Federation of Indian Export Organizations, and Paranjay Guhu-Thakurta, economic journalist. It came to you in the program Money Talk, produced and presented by the News Services Division of All India Radio. This program is also available on our website, newsonair.nic.in. You may email your opinion about this program at airnsdtalks@gmail.com.